So lastly, we'll wrap it up. People that are self-employed, own their own business, whatever the case may be, it's a different process in the qualification and how they verify income.
Right.
What advice can you give for somebody that owns their own business? What's different? How do the banks look at it differently? That kind of thing.
Yeah, so the big difference for self-employed individuals is that we're looking at a longer history, right? So we're looking at a 2-year income average history for them. So they need to really be prepared, and that's the thing. So whereas you could be let's say employed in a job for 6 months and you're past your probationary period and it's easier in that sense, you can come in for a pre-approval much later. When you're self-employed and you want to buy a home, I would say get in to see a mortgage broker right away, because the tendency is nobody likes to pay taxes, and that's the reality of life. So a lot of self-employed individuals just write everything off so that their net taxes are significantly lower.
Okay.
But the challenge with this is it's really hard to lend on that.
Right.
So what we generally do is we'll help you get to a point and run those numbers. And if you say, hey Marlene, I want to buy a house for $1 million, if you can find one for that now, and we'll say, okay, well, your income needs to be at such and such in order for you to qualify for that,
okay.
Right? So we'll really help you step by step get there. Worst case scenario, you've been self-employed for a few years, your first year was startup, you weren't making as good money, and then the second year your business really boomed, so your 2-year average is a little bit low. In the broker side of things, again, very different than the banks or the big five sometimes, we have what we call B lending, so we can lend a little bit more creatively that way. So again, let's say the average mortgage rate is 3%. With a B lender, they might come back and say, okay, you're not quite in the A box, we'll look at the B side, and instead of 3%, you're going to pay 4 or 4.5 or whatever the case may be, and we'll still give you that mortgage. Generally what they'll do is they'll put you into maybe like a 1-year or 2-year term. So it doesn't mean that if your financials weren't strong for 2 years that you can't buy a home.
Right.
It just means that you have to maybe look at some of these options as we get you prepared to get into those next steps.
And that can be kind of a shorter
term.
And then look at where things are with your business and that kind of thing after that.
Right.
And potentially get into a lower rate then.
100%. So you really work with your accountant and your mortgage broker to look at your overall financial goals and financial plan.
Great.
So we're part of your team.
Great. Awesome.